Hello friends, in this video I am going to introduce you to the subject of cost and management accounting, and we will go through few basic terms used in the cost accounting. So the chapter's name is Cost and Management Accounting. We know that there are many subfields of accounting. Till now we have studied about financial accounting. Now we are going to study about cost accounting and management accounting. These two are subfields of accounting. So what is cost accounting and what is management accounting? Cost accounting, as the name suggests, is concerned with ascertainment of costs and recording all the costs that have been incurred in the production of a product or provision of any service. So, cost accounting is recording and ascertainment of costs for the purpose of cost control and reduction. So, what is management accounting? Financial accounting used to provide data to the end management, such as what was the position of the assets and liabilities as on a particular day, or what is the profit or loss of the company. But these figures alone cannot help the management in decision making. They might need other factors, other information, such as, say, how much of the total sales percentage is material cost. How have we done if we compare it to other entities in the same industry? What is the employee turnover? What is the inventory turnover? All these ratios, comparative statements, budgets, etc., helps the management in decision making, which financial reporting alone cannot provide the management. So, management accounting is a subfield which helps management by providing information for planning, organizing, controlling, etc. So let us look at the differences between cost accounting and management accounting. The first difference is the nature of information. So cost accounting is related to ascertaining how much cost or how much money we have spent in the production of a product. Say, for producing a product A, we have incurred raw material of 10,000 rupees, wages 20,000, and other miscellaneous expenses of 20,000. So the total cost is 50,000. This is what cost accounting helps us in ascertaining. So it records only quantitative data. Management accounting helps the management in a decision making process. For any decision, we need both the quantitative as well as the qualitative information. such as it helps to analyze what percentage of total sale is a material cost, how is the employee's turnover, idle time, labor, labor incentives, etc. All these quantitative aspects are also covered under management accounting. So, management accounting records is concerned with both quantitative and qualitative aspects. Number two, the recording of data. So, cost accounting records how much has already been spent in the production of a product. Say last year, we had spent 50,000 on the product. This will be recorded as a part of cost accounting. Say in the current year, due to inflation, the raw material cost has increased to 15,000, wages has been increased to 25,000, and miscellaneous expenses have increased to 25,000 as well. So, we will record the total expenditure of 65,000. Therefore, cost accounting records both past and the present figures. An important part of cost accounting is also variance analysis. Say, if we show the management that the current account figure is 65,000, then we compare it with the previous year to know how much is the increase in cost and what are the reasons for increase. Is it inflation? Is it inefficiency in the production process? Is it labor dissatisfaction, etc.? So we use both the past and the present figures to make decisions on the basis of the costing records. Management accounting is associated more with the future data. That is, the focus is on projection of figures for future. Basis the past data, management accounting seeks to predict what will be the performance of the entity in the coming year or what performance the entity seeks to achieve in the coming future. Next, rules. There's a whole body of ICWAI which governs the cost accounting. So, it has to follow certain principles and procedures recording costs of different products. As we will progress with the chapters, we'll see that there's different treatment of normal idle time and abnormal idle time, say fixed costs, variable costs. So there are certain rules and principles which are followed when we do cost accounting. Whereas in management accounting, there's no specific guidelines because every business is different. The decision made will be different basis on the experience and skills of the management. So, how the management interprets the given data is completely dependent on its own experience. Therefore, there are no set rules. The management can decide to take any course of action basis the information that has been provided to them. So, where cost accounting follows certain principles and procedures for recording costs of different products, management accounting doesn't follow any specific guidelines. It is up to the management to decide what course of action to take basis the given information. Next, area. Cost accounting is primarily concerned with cost ascertainment, that is, how much money we have spent in the production of any product or the provision of any service. So, cost accountancy only deals with cost ascertainment, whereas the scope of management accounting is much wider. It includes financial accounting, budgeting, taxation, planning, etc. The last difference is the objective. So, the objective of cost accounting is recording the cost of a product, whereas the objective of management accounting is providing information to the management for planning and coordination. Next, we are going to look at what is the difference between cost accounting and financial accounting. So, first difference is the objective. We all know that financial accounting provides information about the financial performance of an entity. That is, as part of financial accounting, we prepare the balance sheet, which shows the position of assets and the liabilities on a given date, and we prepare the PL account to ascertain the profit by subtracting all the expenses from the revenue for a particular period. So, the main purpose of financial objective is to provide information about the financial performance of an entity. Cost accounting, as we have already studied, the object is cost ascertainment for cost control and decision making. Second, recording of data. So, in financial accounting, we prepare the balance sheet and the profit and loss account. Financial accounting begins with bookkeeping, where all the transactions that have occurred are recorded. Say we have paid rent of 10,000, purchased goods of 50,000. These entries will be recorded in the books of account, and the balance sheet and the PL is prepared basis these transactions which have already occurred in the past. So, financial accounting only records historical data. Cost accounting, on the other hand, deals with historical data as well as predetermined costs. As you'll progress with the chapters in cost accounting, you'll see that there's a chapter called standard variance, standard costing. So, what happens is at the beginning of a production cycle, the management makes a budget. Say 10 kgs of raw material will be used in the production of 100 quantities. Okay, say for producing 1 kg of finished goods, we will be using 10 kg of raw material and 100 hours of labor. So this is kind of a budget. We have predetermined that this much unit of raw material and labor will be used for the production of the finished goods. But at the end of the production cycle, it might happen that in actual we have used 11 kg of raw material and 110 hours. So this is the historical data. That is the inputs that have been already used in the production, whereas this was a predetermined cost against which this actual is often compared to identify what was a reason for this extra cost. So cost accounting deals with historical data and predetermined costs. Next is the analysis of cost and profit. Suppose a company is producing three products A, B, and C. The total revenue out of these products is 1 lakh rupees and the total expenses incurred is 90,000. So the profit is 10,000. This revenue of total 1 lakh and expenses of 90,000 is shown in the PL account prepared as a part of the financial statements. So we see that the financial accounting gives us the entire profit or loss of the organization. It can be as a whole, and also a segment wise bifurcation may be given. Say, if the company is involved in two businesses, one is foods and the other is, say, personal care. So, and the profit is 5,000 foods and 5,000 personal care. Then the financial statements can give you this bifurcation, but it does not show how much is the total cost and revenue from each of these three products. In cost accounting, we analyze the profit that has been made for each of these individual three products. The total revenue and the total expense is broken down and identified against each product to help the management plan. Say, out of this 1 lakh, 50,000 revenue is product A, 30,000 B, and 20,000 is C. The expense of 90,000 is 40,000 A, 25,000 B, and 25,000 C. So the profit is 10,000 A. B has made a profit of 5,000, whereas C has made a loss of 5,000. So cost accounting deals with the individual profit and loss of all the three products, whereas financial accounting, the total revenue or loss of the organization as a whole or segment wise is represented. Next is a presentation of information. As per Companies Act, schedules have been defined as to how the balance sheet and profit and loss account of the company has to be prepared, what will be the categorization, and under what headings are all the expenses and revenues will be grouped. So, a set format is used for presenting cost information, for presenting the financial information. Whereas in cost accounting, in general, no set format is followed. There are certain principles as to how the costs will be apportioned and what will be the treatment of the cost, but as to what is the presentation format, that is not specifically defined anywhere. Last, we have the users of the information. Now, all the creditors, shareholders, government, etc., is interested in how much profit the company is making. So, the balance sheet and PL is a public document, and the users include shareholders, government, creditors, public, etc. Whereas cost accounting, there is a as an outsider, you will be interested in knowing that 10,000 rupees is a profit of the company. You might not be interested in knowing which of these three products is the most profitable. You will be only concerned with the total profit. This individual bifurcation is actually needed by the management to see which is the best performing product and where improvements are needed. Now, suppose C is continuously making losses over the years, then management may decide to discontinue this product basis this analysis, which is done as a part of cost accounting. So, in cost accounting, the users are generally internal management. Sometimes regulatory authorities may also look at the cost records. So with this we have seen what is the difference between the two main subfields of accounting, that is financial accounting and cost accounting. So now that we have compared cost accounting with the other subfields of accounting, let us look at why do we do all this. That is, what is the objective of cost accounting? Why take so much pain to make so many records? So, the objectives. Suppose you're involved in the business of construction. You have assignment one project with you for building a bridge. So till now you have incurred raw material worth rupees 1 lakh, labor charges say 50,000, and other overheads of 2 lakhs. So far we have incurred 3,50,000 on this project. Cost accounting records it ascertains the costs for each project separately. Suppose side by side along with this project, one more project is given to you for construction of road. So while you've incurred 1 lakh of raw material in the construction of bridge, you have incurred only 20,000 for road, 5,000 labor charges, and 10,000 of overhead, that is 35,000 rupees. So cost accounting deals with separating the total costs among the different cost objects or the different projects to ascertain how much cost has been incurred on each of the project. So the first objective is ascertainment of cost for each cost object. Cost object is nothing but the item for which the costs are measured. In this case, the cost object is a project. We have to determine how much money we have spent on each project. In the previous example, where the entity was producing three products, the products were the cost object because we were measuring how much money is spent on each of these three products. Next, now we know that in project 1 we have incurred 3,50,000 rupees, or say we have just started with this project and we have estimated that 3,50,000 rupees will be incurred on project 1 and 35,000 on project 2. So basis this analysis or basis this projection, when we make a quotation to the buyer, say we put a 10% profit margin. So we will quote a selling price of 3,85,000 for for project 1 and 3,85,000 for project 2. So cost accounting helps us. It provides a basis for price fixation and rate negotiation. Now suppose we are sitting with the buyer, that is the person who has assigned us this project, and he says that 3,85,000 is too high a price to quote. So we know that we have estimated the total cost of 3,50,000. So if the negotiation is done, we might reduce the profit margin and say we agree at a price of 3,75,000 for project 1. But we will not want to reduce before 3 lakh below 3 lakh 50,000, because then we will making a loss. If we did not have all this data, then it would have been difficult for us to fix a selling price and do effective negotiations with the buyer. So the second objective is the determination of selling price and profit. Suppose for project 1 we had estimated that raw material will be 1 lakh rupees, labor charges 50,000, and other overheads 2 lakh rupees. So 3,50,000 was a total cost that we had estimated at the beginning of the project. Now, as the project has started and as we now incur these expenses, since construction is a long can be a long project of say 1 year and expenses are incurred in stages. Say in the first month we have purchased raw materials worth rupees 5,000, labor charges of 1,000 has been incurred and overheads of only 500 rupees. So 6,500 has been incurred in the first month of the project. So during the entire tenure of this project, management keeps on keeps on measuring the actual cost against the estimated cost. Say by the fifth month, we have incurred a cost, a material cost of 80,000 rupees, labor charges 60,000, and overheads of 1,20,000. So total costs of 2,60,000 has already been incurred on this project. So we can see that the labor charge has actually exceeded the estimated amount. So now, since the labor cost has exceeded, the management might take steps to reduce the further overheads and will try to control the labor charges. It will try to identify how has this, why was there an increase in this labor charges. So all this process forms part of cost accounting. So another objective is cost control, that is ensuring that all the expenditures are in line with the predetermined set standard. Any variation is noted and reported on a continuous basis so that corrective actions can be taken. Now, say we have completed this project and the total actuals that have been incurred is 1,20,000 raw material, labor of 80,000, and overheads was say 1,90,000. So we have incurred a total of 3,90,000 rupees on this project. Now, when we go for other projects, say for building the road, we have already had an experience of this project. So we might try to identify where we can reduce the cost in our future projects. Say we can change the quality of the raw material that we use in our other project. Because of the change in quality, the raw material will only be 1 lakh rupees. We could use more efficient technology because of which the overheads can be reduced, and with the use of technology, less labor will have to be deployed. So these brainstorming sessions keep on happening basis the data which is available with the management to achieve a reduction in the unit cost of the products. So next objective is cost reduction, that is achieving a real and permanent reduction in the unit cost of the goods manufactured without reducing the quality of the product. As the entity gains experience, it might identify places where actual cost cutting can take place without affecting the quality. Next is the assists the management in decision making. Suppose in the previous example only, A, B, and C were the three products. So C had made a loss of 5,000. If year on year C continues making losses, management may decide to discontinue the product. Say if the raw material cost keeps on increasing product after product, management might look into changing the supplier because maybe there is some issue with the supplier because of which there is increased fault in the finished material. So All these costing data helps the management to make such decisions. In these objectives, we saw two terms, cost control and cost reduction. While these two might sound similar, they are actually very different. So, cost control and cost reduction. Cost control, as I explained before, is ensuring that the actual cost is in line with the predetermined cost. So, it aims at maintaining the actual cost in line with the established standards, whereas cost reduction aims at reducing cost. Number two, in cost control, the emphasis is on past and present. That is, we compare the present expenditure incurred on the project with the predetermined standards, that is, the standards that were set in the past. Whereas cost reduction focuses on the present and future. That is, given the present expenditure, we try to estimate or we try to forecast in which areas we can make a change that may result in a reduction in cost in the future. Third, the process of cost control ends with when the targets are achieved. That is, for project 1, the estimated was 3,50,000. When the project was completed, during the course of the project, we used to keep on measuring the actual expenditure against the standard sets against the set expenditure to ensure that we do not exceed the estimated expenditure. But when the project is finished, then the cost control process for this project will also get completed because we will know what is the actual against the estimated cost. But cost reduction has no visible end. Say, in the second project, we are able to achieve a reduction of 10,000 rupees. When we do the third project, we might identify few more shortcomings in our process because of which we may again achieve a reduction of a further 5,000 rupees. And this process goes on and on as the experience of the management increases. So cost reduction has no visible end. Next, cost control is a preventive function. That is, its aim is to ensure that the actual cost does not exceed the estimated cost, whereas cost reduction is a corrective function. That is, we seek to identify what are the loopholes in the existing process so that we can improve it in the future and thereby achieve a cost reduction. So, while cost control aims at maintaining the actual cost in line with the standards, cost reduction aims at reducing cost. Cost control's emphasis is on the past and the present data, whereas cost reduction focuses on the present and the future. Cost control ends when the targets are achieved, while cost reduction has no visible end. Cost control is a preventive function, whereas cost reduction is a corrective function. With this, We come to an end to this video. I hope these concepts are clear to you. If you have any doubt, you can post them in the comments section below. Thank you.